The U.S. housing market has been defying gravity for years, but now, even the luxury segment is showing cracks. For decades, million-dollar homes were considered safe investments, immune to rate hikes and downturns. But new data shows that luxury sales are slowing, supply is rising, and even wealthy buyers are pulling back. What does this mean for the rest of the housing market? Let's break it down. What the numbers show. Luxury home sales, the top 5% of the market, fell nearly 1% year-over-year in the 3 months ending August 31st. It may sound small, but it marks the weakest August on record for Redfin. Median luxury home prices are still rising, up about 3.9% year-over-year to $1.25 million, but that's far below last year's 6% growth. Inventory of luxury homes is up nearly 10% compared to a year ago. More sellers are listing, just as buyer demand is fading. Why luxury buyers are pausing? Economic uncertainty. Even high-net-worth buyers are worried about inflation, Fed policy, and market volatility. Interest rates. Wealthy buyers may pay cash, but rates still matter. Financing, opportunity cost, and alternative returns factor in. Wealth volatility. When stock markets dip or business profits shrink, luxury buyers delay big purchases. Confidence. Luxury is about prestige. When sentiment turns cautious, demand slows quickly. Why this matters beyond the rich? Luxury markets often act as a leading indicator. If the top tier slows, it can filter down to mid-tier and starter homes. Price psychology is contagious. If buyers see luxury listings sitting longer, they may hesitate across all price ranges. Developers who banked on endless demand for million-dollar builds may stall projects, cutting jobs and construction activity. Investors, many institutional funds piled into luxury rentals, could exit if yields fall, flooding supply into the market. Is this 2008 all over again? Not exactly. Lending standards are stricter now, and most homeowners are locked into stable, fixed-rate mortgages. We don't have the same flood of risky loans that triggered the last crash. But today's risks look different. Affordability is worse than in 2008 when measured by income versus housing costs. Investor ownership is far higher now, which could magnify selling if conditions turn. The job market is softening, and unemployment creeping higher could amplify housing weakness. What you should do? If you're a buyer, don't assume luxury prices will keep rising. Bargains may appear in the next 12 to 24 months. If you're an owner, hold steady. Don't panic sell. Luxury is more resilient than mid-tier, but patience matters. If you're an investor, remember liquidity can disappear quickly in high-end real estate. Be cautious about over-leveraging. Conclusion: the luxury housing market isn't collapsing yet. But it is slowing, and that's a warning shot. If even the wealthiest buyers are stepping back, the rest of the market could follow. Do you think luxury housing will drag the whole market down, or is this just a temporary pause? Let me know in the comments. And if you found this breakdown useful, hit like, subscribe, and turn on notifications for more no-fluff financial insights.